Did you know you can use the equity in your home to pull money out and buy an investment property or a second home? What does that mean when I say pull the equity out of your home? Well, think of your house like a piggy bank shaped like a house. And when you make payments on your mortgage every single month, the balance starts to go down on the mortgage. Additionally, home values have increased at record amounts over the last several years, sometimes 20 and 30% per year. So as your mortgage balance was going down and the value of your home increased, that created a lot of value within your home that can actually be accessed and pulled out to utilize for other purposes. Again, like a second home or an investment property. Did you know the average American right now has at least $300,000 in equity in their home? That's a lot of money just sitting there, not necessarily working for you. So what you're able to do is one of a few things. You could either do a home equity line of credit or a second mortgage and pull the money out of your home and keep your existing mortgage intact. So what that means is, again, a lot of people do have sub 4% mortgage interest rates and they don't want to disturb them, but they do want to pull the equity out of their home. So another way to do that without refinancing that first mortgage would be to get a second mortgage. It goes behind the first mortgage. It's filed on the property as a lien right behind that first mortgage, and it can be done as a home equity line of credit or second mortgage. Let's break that down. So a home equity line of credit is exactly what it sounds like. It is a line of credit. It is a revolving line, and it will move with you as your life changes and you have different needs. So if you get approved for a line of credit, let's just say you had enough equity in your home and you wanted to pull out $100,000. If you were to get a line of credit for $100,000 but not draw any money out of it, you would not make a payment on that loan other than potentially a small annual fee that the banks will charge. It could be $60, something along those lines. But until you draw the money out of the line, you don't make a payment. It's a lot like a credit card. As the balance goes up, your payment, which would be interest only required typically, will go up. As you pay the balance down, your payment would go down. This is a great thing to have for self-employed people, people who their income maybe fluctuates, or someone who gets a lot of commission and bonuses at the end of the year. You could utilize a line of credit like this, pull the money out when you find a home. Maybe you're not ready to find a home. You just want to be prepared. And then go ahead and use that for your down payment, get your mortgage on your new property that you're purchasing. And when you get big lump sums of money, you could pay that line of credit down, therefore bringing the balance down. The line of credit typically stays open for 10 years. You can draw on it, pay it down, draw on it, pay it down as much as you wish. And at the end of 10 years, it locks in on a 20-year amortized term. So that's one option. Another option would be just to do a true second mortgage. So that would be a fully amortized, maybe a 20-year loan typically, that is amortized, could be 15 years. Over that period of time, you would make a full PITI payment, so principal, well, really just P&I, because your taxes and insurance most likely are being paid on your first mortgage. So principal and interest payment, and you would make that every month. Once you take that second mortgage out, you get the full amount of money all at once, unlike the line of credit. And you go ahead and start making payments just like you do on your first mortgage, and every month that balance just goes down. So a little different than the line of credit, a little bit less flexible, but maybe feels more secure because you know the payment every single month and you know you're paying that loan down. Home equity lines of credit sometimes have a tendency to sit out there and the balance never gets paid down because either someone doesn't have the excess money to pay principal above the interest required payment, or they're just not disciplined enough to do it. So sometimes that's not a great option if you are not someone who has that extra cash every month or the discipline. And the third option that sometimes makes a lot of sense, depending on your situation, would be to go ahead and refinance that first mortgage. So even though you have a sub 4 or 3% interest rate, depending on the balance on that first, the ratio, and how much money you want to get out of your equity, it's never a good idea to stack a very large home equity line or second mortgage behind an equal or lower first mortgage balance. You're going to be top heavy with that higher interest rate because HELOCs and second mortgages typically carry a rate somewhere around the prime rate, which right now, today, as of this filming, was 7.75% with a margin added on top of that. So you might see a rate of 8, 8.25, 8.5, maybe even 9%. So when you're stacking a large loan behind a smaller loan with a low rate, you're top heavy and your blended rate is much higher than you think. In that situation, just a cash out refinance at maybe somewhere in that 6% range right now, maybe even high sixes, would get you a large sum of cash out of your home if you have a lot of equity. Bring that payment to a realistic amortized PITI payment, so you're paying down principal every single month, and you're not creating that top-heavy, really high interest rate second behind a small, lower interest rate first. You would just have one loan at a reasonable average rate as of today, and you'd be able to get that money out and utilize it to pay off debts, maybe to do home improvements, and maybe again to purchase another property or investments or anything that you could take that money and make it work for you. So these are ideas and ways to use that equity in your home. Again, your home is your piggy bank shaped like a house, and it has money in it. It has your investment in it. You've spent time making payments. You've paid that mortgage down. The home is appreciated. It's sometimes a really good idea to tap into that equity and leverage it to do other things where you can make money in other areas, pay down debt, etc. If this sounds like something you are interested in or you have more questions, reach out to the Oddo Group. We'd love to help you and figure out a great strategy for you.